Well, a few weeks ago, we heard about almost 100 Canadian business executives signing an open letter asking Ottawa to alter the rules surrounding pension fund investing. Canada's finance minister had some of that in focus at last week's budget, where, along with all the budget announcements, we saw Chrystia Freeland announce the former Bank of Canada Governor Stephen Poloz would be stepping in to examine some of the ways by which pension funds could be interested in putting more capital to work here at home, including in areas like housing and infrastructure. Now, in recent decades, obviously, Canada's big pension funds have become major global players. That comes from investing a lot of capital in foreign markets to try to get big returns. But because you've seen so much investing abroad, that sparked quite a conversation here, which in many ways was kickstarted by Letko Brosseau, the investment firm. Daniel Brosseau is the co-founder and partner and helped to get that open letter together. He joins us from Montreal. Daniel, nice to have you back with us. Appreciate the time.
Good morning. Thank you for having us. We
know that the federal government, the federal Liberal government, had been openly talking about this idea of seeing more invested here at home. You'd seen a lot of the pension funds push back on that. And then the budget comes and we learn that the former Bank of Canada Governor Stephen Poloz is going to step in and try to work through, I guess, a few of the options. What was your reaction to that?
Well, it was very positive. The question that was raised originally a few years ago was like, the pension funds had become the largest, because of government incentives and things like this, tax incentives, pension funds had become the largest institutional, or in fact the largest pool of savings in Canada, and it was moving away from Canada. If you thought, for example, that the banks would take 2/3 of the savings deposits of Canadians and used it to make loans to the US or China, and that if you were a Canadian company, you'd have to go see a foreign bank to get your financing, people would kind of react quite strongly, I would think. Our national pension fund, CPP, has 2% invested in Canadian private and public equities, and has 55% invested in foreign ones. So this is what kind of got us on this case. And this was all happening under the radar. So the question then is, it could be something that Canadians decide makes a lot of sense to take our savings and encourage the development of other economies and invest just a little bit in our own. But it has to be a conscious decision. It has to be one that we arrive at through discussion. So we're very happy that this has now come forth as being something that needs to be discussed. And we're quite happy with the choice of the moderator of this discussion, because he has all the required skills and knowledge to be able to understand what the real issues are. So now it becomes a question of this, what is going to be the nature of this discussion. And I noticed in your intro that you talked about returns and things of that nature. And in fact, it really isn't about returns, because returns in Canada have been better than the returns just about everywhere else in the world for quite some time. Over the last 25 years, the TSX has outperformed the Morgan Stanley EFI by 4% per year. It has outperformed the S&P and the Morgan Stanley Emerging Markets funds by close to 1% per year. So even if the returns have been better, they would still have left Canada. The pension funds would still have left Canada. And it's also not about diversification, because when you have CPP investing 2% in Canada and 55% elsewhere, well, the 2% really becomes irrelevant, and you don't need to invest 55% elsewhere to diversify yourself out of the 2%. So it's really not about diversification. And it's been commented that maybe Canada is not very competitive and doesn't have very interesting places to invest and things like this. which evidently you want Canada to be even more competitive. There's no doubt about that. But Canada is already very competitive. The IMD 2003 World Competitive Rankings that were published late last year showed Canada to be in the top quartile amongst all the world economies in regards to competitiveness, and second, just after the US with regards to the G7. So we should make Canada more competitive, but even if it was more competitive, doubt that there would be much more invested here nonetheless. So what is the issue? What is causing this problem? And interestingly enough, it's a clash of titans, because we have two economic theories. One, portfolio management, that says that Canada's 3% of world GDP and 3% of world markets, and a diversified portfolio should have just 3% invested in Canada. Anything more is a bit of overweight. And it's only interested in risks and returns. Now, you have another theory, which is macroeconomic theory, that says that a country should invest all it can in its own development, because that's the way it's going to increase its productivity, its incomes, its jobs, and its general wealth. So it also states that a country is better off controlling its future by controlling its companies. The corollary of the portfolio management theory, which says just 3% in Canada, means that basically you're giving off to foreigners the control of your companies. So we have two theories that are coming to very dramatic different conclusions. Portfolio theory that says invest very little in Canada, leave the control to foreigners, and macroeconomic theory that says invest all you can in Canada and keep control of your companies.
But Daniel, just to jump in as well, I think there is a political component as well, because I do have to be clear that when we've talked to people who previously ran pension funds, people who previously worked in Ottawa to talk about their views on this idea, very quickly we've had people shutting it down. And I think there's sort of a broader view that having the federal government messing with where the investments are going gets us on this complicated sliding scale. That's just my own 2 cents on the matter, but I'm listening to what you're saying, which all makes sense. But there are a lot of people who are reluctant to even have the conversation right now, and I would imagine it's because of that bigger political takeaway as a worry.
Right. So governments have been regulating financial institutions for many, many, many decades. They regulate the banks, they regulate the insurance companies, and even the regulators of the pension funds. And the regulations of the banks and the insurance companies are not really contested that much. There's always a little something here, a little something there, and things like that. But there's no question that the government can regulate it. Now, this idea that the government is going to step in and tell the economic agents where to invest and how to invest and things like this is not part of the ask. It's just that right now we have a system that does not take into account the macroeconomic effects of investment. And these macroeconomic effects are large, very large. If we look at a $5 investment, for example, and you talk about a 1% effect on the returns, that's 5 cents. OMERS published a study on their website recently that kind of indicated that a $5 investment added $1 to Ontario's annual GDP. So you can't ignore that the $5 investment has the potential of adding $1 to Ontario's GDP or Canada's GDP. Right now, we're taking that $5, investing it in the US and investing it in China and adding to their GDP. The question is, maybe we should think about adding it to our GDP. So it's a question that needs to be asked and needs to be discussed. As I said, if people decide that the best thing is no, we let that money go and we don't encourage our own economy and things like this, that's the best for the country, so be it, we'll live with it, no problem. But it cannot happen by accident. So this discussion that's going to occur is going to be quite important. And I agree with you that how the government decides to resolve this and how, does it act on specific industries, tweak this, tweak that, or does it set a general environment that's conducive or brings in this macroeconomic effect into consideration, is going to be part of the discussion. And those that are arguing that the government should not be directive but should act on the environment, we would agree with that.
All right, Daniel, I just want to get one more question in here. And just for our audience, we talked about the Canadian business leaders who had signed the letter that you guys were instrumental in sort of bringing this to the forefront. The banks have been pretty quiet. The banks, one could argue, they serve, the business community, and a lot of the businesses that signed that letter, they also serve a lot of the pension funds as well. But one idea I have heard from one bank CEO privately is there a compromise area here where we have all these big investments we need to make for the future? We have to make big investments in areas like infrastructure. We're talking about a clean energy future. A lot of these pension funds have been putting money to work in such projects around the world. Would there be some opportunity to find common ground towards investment? I'm asking that question because if the former Bank of Canada governor is coming in to look at options, I would imagine, finding some common ground here would be the goal.
Well, of course, this is why this discussion is so important. It is to find common ground. There is no use to resolve this by imposing things that make no sense. So common ground is very, very important. What we hope is that this discussion is going to be very open. It's not just going to be between pension funds and government. There are a lot of other people that have interests in this. We hope that it's going to be a true dialogue, and it's going to be properly framed so that we're going to be discussing the true issues.